Well, hello and a very warm welcome to this Scope Ratings webinar, Middle East, Mapping Geopolitical Spillovers and Assessing Credit Impacts and Linkages. My name is Keith Mullin and it's my pleasure to be moderating today's session. I'm delighted to be joined today by analysts from three of Scope's rating franchises. So let me introduce you to Carlo Capuano from the Sovereigns team, Carl Pettersen from the Corporates team, and Ángela Cruz from Financial Institutions. Hi everyone, great to see you. Thanks so much for your time today. Now, before we get into the credit discussion, we do acknowledge sadly that the events driving these dynamics involve human suffering and loss of life. So while our role today is to assess the credit and economic implications, we are fully aware that these developments are first and foremost human tragedies. So what are we going to be talking about today? Well, the idea is to offer an integrated perspective on the forces driving credit risk and potential impacts, and how geopolitical developments intersect with other major themes shaping today's credit environment. We'll look at how the situation in the Middle East is transmitting across geography sectors and the rating scale. We'll look at how energy price spikes transmit to credit risk. We'll look at some of the most exposed sectors and countries, and we'll touch on some second order effects in markets. Now, the way we set this up is each of our analysts will make some brief comments to slides, and then we'll move to Q&A. So on that point, we'll be absolutely delighted to take your questions. So please do type these in as we go along. And I'll just add before we start that the Scope team has published various comments on some of the sector impacts, including airlines, chemicals, oil and gas, banks, even glass makers. And we did also run a corporate stress test model. All of that can be found on the Scope Ratings website, www.scoperatings.com. I do commend them to you for a good read. So that's it from me. Let's dive straight in. Carlo, I believe you're going to start, so the floor is yours. Perhaps we can maximize this my presentation.
Thank you. Thank you very much, Keith. So I think it's important, probably, if we want to assess the credit risk for sovereigns, to start with two, key messages. So the first one
Carlo,
is,
okay, sorry.
right. Yes, regarding the two messages. Yeah, the first one is regarding sovereigns. That of course the impact will depend, on the duration, the severity of the conflict, and the developments in the Strait of Hormuz at the moment. Of course, there are two key transmission channels. One is the energy markets, but also economic sentiment. So we don't have to forget that also, economic sentiment could affect, investment, tourism, and eventually this will weigh on growth. Um, we focus in the sovereign team our attention to the impact in particular on EU countries. So we try to identify what are the most vulnerable to the oil and gas price shock using a combined vulnerability index, assessing the import dependency, the energy mix, but also how important is oil and gas for these economies. And we identified regarding the oil price shock that Cyprus, Greece, and Bulgaria could be probably relatively more exposed, while is regarding the gas price shock, Slovakia, Hungary, and Italy. The first week of the conflict, we put out a note where we focused on a scenario. So we performed a scenario on the on this conflict, and in our view, so the expectation is that this scenario, so this conflict will be short-lived and the overall impact will be lower than what we saw when Russia invaded Ukraine. But in any case, there are wider implications both for the EU but also for the US. For the EU, of course, we can expect additional inflation, potentially require monetary policy tightening. We have seen already governments announcing support measures, in particular subsidies to protect firms but also households. Regarding the EU cohesion, so this conflict is testing the EU cohesion, so we don't see a unified position at EU level, so and this does not bode well for EU integration. We have a clear winner so far, which we could say Russia. So as you know, Russia is generating additional revenues thanks to higher energy prices and also lower US sanctions, and the attention is a bit away from Ukraine. Regarding the US, we might expect higher inflation, but also additional defense spending that could weigh on the US growth and widen the fiscal deficit, which is already very high. I think a key point is to assess is whether the US will decide to stop the conflict, and what Israel could do. Israel could decide to continue this conflict with Iran, and this might continue to have implication for the Strait of Hormuz. But let me take a step back, and focus our attention on the importance of the Middle East, in particular regarding the production of oil and gas. And if you can see from this slide, the Middle East is super important, in particular for the production of oil. So 1/3 of the total world production is produced in the Middle East, but also gas. We are speaking about 20% overall. So imagine if the Middle East is out of the oil and gas market in terms of exports. So what could happen in terms of implication might be even more severe than what we saw when sanctions were imposed on Russia, because Russia production regarding the oil is much lower, and also for gas. Regarding consumers, of course, those areas that will be most affected probably will be Asia, but also Europe. Instead, US is expected to be, self-sufficient. Let's dive in on our focus on the vulnerability, in particular for to the oil shock. So here on the chart on the left, we have the dynamic of the oil price and also the futures. And if you see that the oil price has increased, but has not achieved those levels that we saw in 2022, and the expectations embedded in the futures still point to a gradual decline, probably reflecting the view that this conflict is short-lived. We should, take this expectation with a pinch of salt, and not due to the high volatility. Regarding the vulnerability, so here we built a combined vulnerability index that again takes in consideration the import dependency, the energy of mix, the importance of oil for the overall economy. And according to our analysis, probably Cyprus, Greece, and Bulgaria are the most vulnerable, at least on paper, according to these three dimensions. Similarly, we do the same exercise for gas. Here again, if you look at the gas price, the increase is not comparable to the levels that we saw in 2020 and 22. Of course, things might change, but regarding the vulnerability, so here instead we identify with the same logic Slovakia, Hungary, and Italy, for example, is relatively exposed to the gas that is imported from Qatar. In this slide, we provide basically the combined vulnerability index according to the oil and the gas shock. And if you can see, Greece basically is exposed, equally to these two shocks, while is, as we said before, Slovakia, Hungary, Italy are, for example, more exposed to the gas shock, and a bit, relatively lower exposed to the oil shock. But let's go to our scenario, the one that we presented, the first week of the conflict. So we assumed that the gas price will reach 50 euros, and the oil price will reach $100, and we try to identify the overall cumulative impact over 3 years in terms of additional inflation and lower growth. So this is represented by the bars on the left, and we compared these results with what the ECB presented when Russia invaded Ukraine in March 2022. So we saw that the ECB in March 2022 was, presented a base scenario, but also a severe scenario. So first message I would say is that in our view, the conflict is expected to be short-lived and contained, so the overall implications probably will be lower in terms of higher inflation and lower GDP than what was expected by the ECB at the beginning of the invasion. But then, if we look at the actual, so what really happened with the bars, to the right, we see that the impact of the Russia invasion of Ukraine in terms of additional inflation and a lower GDP growth over a 3 years period was much higher. So what I want to say is that reality might be much worse than what we initially think. So for this reason, I think it's important to continue to monitor the evolution and if there is an escalation of the conflict. And I would say with this positive note, I would hand over to Karl.
Thank you, Carlo, and thank you for giving us a bit of a narrative anchor where Ángela and I can then dig deeper. And hi, everyone, and thank you for joining us today. Before I jump into the 2 slides of data that I'm going to share, I wanted to make a few comments just to frame a bit of the approach. When we talk about transmission into corporate credit risk, this is where we start grappling with a different order of granularity in some ways, and also where the complexity of these transmission mechanisms becomes apparent. So my aim today is really to try to distill this complexity to a few factors and a few narrative threads to help us build a bit of a coherent logic and frame what we're facing. So what we did here, there are a number of ways to examine transmission mechanisms into corporate risk. What we're presenting here is the output of our proprietary trade stress test model, which is a large macro model that examines the transmission of specific shocks through global supply chains and generates a new equilibrium point. So as a model, it has limitations, but the outputs have a lot of value in 3 ways. One, it allows us to identify vulnerabilities in terms of economic output by region and by sector. Then by using long-term correlations between economic output and default rates, it gives us an indication of where probabilities of default might be the most vulnerable to change and in what direction. And finally, it gives us a lot of insight into what these transmission channels look like. And to echo Carlo's comments, nobody has a crystal ball. The length of the conflict is still very much a question mark. So best to think of these views as a little bit of a vulnerability assessment. What is notable here as well is that these outputs align very closely with the analysis from Carlo's team, as well as what we're seeing on the ground so far. So perhaps to jump into it, and I'll keep explaining a little bit what's on the screen, but we ran 2 scenarios, which roughly produce energy costs expressed in dollars per barrel of oil here. One scenario at around $94 to $95, and another one at 130. And we see 3 main themes when we run these scenarios. First, to echo what Carlo was saying, I think on average, the EU as well as the US tend to fare the best of all regions globally. Everyone is affected, but the effects are probably more absorbable in these regions. Secondly, within the EU, risk transmission is very uneven. It's uneven by country, it's uneven by sector. And thirdly, there's a range of transmission channels. Some of them are physical, some of them are economic, some of them are a little bit more corporate specific, and I'll touch on these. And also these can be sequential transmission channels, or essentially have different curves in how quickly they manifest. So what our model gives us is essentially a way to think of this. So if we zero in on Europe specifically, we see that Southern and Eastern Europe on a kind of corporate risk basis are also affected more immediately and more acutely, and also within these regions show a lot of unevenness. This is in large part a function of energy intensity, energy mix, the composition of local economies, relative cost positioning, and exposure to certain specific sectors. For example, Southern economies can be more exposed to changes in shipping flows, et cetera. And all of this impacts competitiveness and therefore credit risk as markets find a new equilibrium. So if we talk in terms of default risk, right, and which is at the heart of credit risk, what the model gives us is indications of how probabilities of default are likely to move. So here we purposefully aggregated them by sector, and we compare these increases, these suggested increases in probability of default, to the general step changes in default risk that we observe in investment grade and especially in triple B land and single A land, based on our ratings transition matrices, idealized default curves, our data. Here we focus on investment grade risk, simply because investment grade issuers tend to represent a much larger and a more systemic proportion of output than non-investment grade. But on non-investment grade, because transmission channels are more concentrated and because these credits tend to be more vulnerable, almost by definition, we would expect these effects to be likely more pronounced and also more unpredictable in their severity and fundamentally more case-specific, a bit more idiosyncratic in non-investment grade. So this graphical illustration here, to help you read it and not to go into too many technical interpretations, but in essence, the green bars represent Europe-wide the increases in default risk that correlate with a comfortable positioning at existing investment grade ratings. The yellow bars I would interpret as less comfortable but still contained, right? And then the further you move to the right is where default risk the increases in default rate start to creep outside of bounds. So in practice, this doesn't mean ratings change, but it does suggest that probably more deliberate offsetting action by companies starts to make sense. So if we look across these sectors, a few takeaways. I said 94, this is $100 per barrel. Chemicals are immediately affected, and they're also affected disproportionately in vulnerable regions. The same goes with metals and minerals, and mostly on the metals side. This adds to the existing structural pressures, which are well publicized around these sectors, which already reflect, higher energy prices in Europe, and also things like global chemicals overcapacity. However, as these risks transmit, you also start to see substitution effects. So, anytime there's a price movement, it's always income and substitution effect, if you recall your introductory economics classes. And certainly where we could see more acute effects in chemicals on China and India, for example, this could induce a substitution of demand back in Europe to a degree. So all this is built into the analysis that we have here. What's also notable is you see, obviously, the energy sector tends to benefit overall from higher prices, but you see a mixed effect on utilities, which is really a reflection of different utilities and different regions' exposure to natural gas, fundamentally. So again, that unevenness and that kind of concentration of risks becomes apparent. If we move to the more acute scenario, what becomes noticeable is you see, firstly, a more pronounced effect, which is not surprising, but also you see different effects. You'll notice that new sectors start to jump to the front, start to leapfrog the others a little bit. And this also starts to tell us about corporate-specific transmission mechanisms. So here, in addition to the sectors that stand out at $100 oil scenario, you see pharma, textiles, and food and ag that start to show an impact in terms of potential increases in default risk. And that's largely through the chemicals chain, ultimately. Where it also becomes interesting is that you start to see corporate and reporting effects come into play. For example, if you were to really dig into the data, you would see some concentration of pharma export effects being reported within part of the Irish economy, which is more a feature that is common to corporate analysis, i.e., it's a reporting convention, it's reporting language and accounting constructions, as opposed to perhaps pure economic reality. So something also to keep in mind as we see these effects propagate. So once again, while we see this level of discomfort increase and you see the brown and red bars grow, we're not suggesting that this necessarily changes ratings, but rather that this could well merit a response. For example, in the form of changing capital allocation priorities, as the calculus of risk and return also changes. Also importantly for corporates, this does not directly address questions of investor confidence, which play an important part in markets today, in which I think we all know are coming under a little bit more scrutiny, given where market pricing indicators are at the moment. On this point, really quickly, we've commented on this in our corporate outlook earlier this year, which I would encourage you to look at as a complement to this. And additionally, this is also an area where we're exploring where we can add good market commentary. So in summary, transmission mechanisms in corporates are a mix of price, of substitution effects, of physical effects, and also, frankly, of accounting effects. So nobody is fully unaffected, but it's the mix of these effects and their direction and the extent to which they compound both together and with existing market trends that creates this unevenness. But through a variety of sources, including this modeling, we can now discern orders of magnitude that help direct our understanding and our analysis, and I hope are also useful to all of you who are attending this webinar. And with that, let me pass it on to Ángela.
Thank you so much, Karl. Hello, everyone, and thank you for joining us. I am going to focus on the potential impacts we can see on European financial institutions from the situation currently in the Middle East, and recap a little bit what it means for banks in Europe in terms of the trends that both Carlo and Karl mentioned from the sovereign and the corporate exposures as well. The first thing I would like to highlight is that downside risks from geopolitical tensions currently is one of the key risks we highlighted in our European Outlook reports that we've been publishing for the past few months for 2026. So we think that this is one of the key materializations of what could potentially happen that we have already highlighted is a downside risk to our current base case incorporated in our ratings for financial institutions in Europe. The first thing that we focused on is analyzing to what extent there could be an immediate transmission mechanism of current tensions already in the very short term from direct exposures to debtors in the region. The picture very clearly shows that direct exposures by European banks in the region is very limited. Unsurprisingly, direct exposures to Iranian debtors is negligible after several years of international sanctions. And also direct exposures to other debtors in other countries in the region are relatively limited. According to EBA risk transparency exercise, what the banks have been reported on individual basis, most of the exposures are focused on sovereign debtors, and they really represent a minimal proportion of balance sheets. So in this regard, we think that the risks are relatively contained. What we think can be more impactful is second round effects. And in this regard, it really will depend on not only the extent of the conflict and whether it escalates, but also the length during which this will happen. And therefore, as I think Carlo was explaining as well, is not only the impact or shock on energy prices, but also potential impacts on economies. We think that this impact is less likely to be immediate. It's more a medium-term impact if it were to materialize. And what is very relevant is that obviously it is very bank specific in terms of specific banks' exposures to different sectors and the makeup of their loan books, as well as their balance sheet structures. But we think that looking at big picture, sector level, vulnerabilities in this regard is already helpful for us to understand what factors we'll be monitoring going forward. We've tried to map in the left-hand side of the slide those banking systems that are more vulnerable to impacts on energy prices, both from oil and gas, and the exposure or having high exposure to corporate sector, because we tend to see sooner in asset quality impacts the effects of the shocks in energy prices in the corporate sector than in households and other private sector segments. In this regard, I think it's not surprising either that we see Greece as ranking relatively highly vulnerable in combination of these two factors. I think Carlo already highlighted from the macroeconomic perspective the vulnerabilities. It's also a banking sector that is highly exposed to corporate lending. We also highlight Italy. It's more exposed to impacts on the gas side, but it is also a banking system that has a fairly high component of corporate lending, and particularly SMEs. When we look at and bringing into the analysis, Karl's analysis on a specific sector impacts, we also see that these two banking systems are more exposed in terms of the type of sectors that compose their corporate segment loan book. The Greek banking sector has meaningful exposures to transport, also to electricity, gas, and water supply, and in a follow-up knock-on effect on agriculture and mining as well. You can see that there are some effects on manufacturing, which encompasses many of these sectors as well that Karl was detailing in a greater breakdown. In the case of Italy, is something similar in terms of manufacturing. It could have an impact as well. And other jurisdictions that we're monitoring for potential impacts in this regard would be also, for example, Germany, where we would see potential impacts on the manufacturing sector as well. We take into account this is a high-level picture. There could be other transmission mechanisms because of these exposures. So if we were to see as a second round effect that there could be a change in in interest rate policy, that could also affect asset quality trends in other sectors that you see there featured prominently in some of the jurisdictions' corporate loan books in terms of exposure to rising interest rates, which is generally a negative factor for asset quality, but is particularly important, for example, for real estate and construction. Generally speaking, second round effects will be very meaningful if they materialize in terms of business growth outlook, and also it could affect financial profiles in different ways. But we think this is a really good picture overview of how we would monitor specific banks in each of these sectors. The other transmission mechanism that we are monitoring closely, because it can have effects in a shorter term, but also in the medium term, is the potential impact from disorderly financial markets correction. We think we've also highlighted this as a potential downside risk to what we incorporate in our ratings currently, particularly because we've come from a period in which market liquidity has been very abundant. We've seen very tight spreads, and corrections from the current levels could be meaningful. So in this regard, the European banking systems in general are relatively well positioned to absorb episodes of illiquidity bouts or spikes in spreads for as long as they're short-lived. However, if that were to continue over time and we saw more challenging funding conditions, that could become an area of pressure for some of the European banks' profiles. We're monitoring more closely those systems where the reliance on wholesale funding is bigger, and there is a lower proportion of granular, low cost deposit bases, because one very clear transmission mechanism would be a relatively sustained increase in wholesale funds cost. We're less concerned about the systems that, despite having some reliance on wholesale funding, there is a big component of less volatile type of wholesale funding, for example, cover bonds, which is the case in several jurisdictions like the Nordics. But having said this, this is something we're monitoring relatively closely. And this basically encompasses the three main routes that we see for potential impacts. I'm going to stop here and hand over again to Keith.
Good, thank you very much, Ángela, also to Karl and Carlo for those comments. We're going to move to Q&A in a second, but we do have one final slide here, which I guess is the wrap-up of the comments to date. Carlo, could I prevail upon you just to run us through the takeaways very quickly, and then we'll move to Q&A.
Yes, of course. Well, as we said, on the sovereign side, we identified, southern and eastern European countries, more vulnerable. We think that the conflict, is expected to be short-lived, so the overall, impact on sovereign credits probably is manageable. On the corporate side, as Karl said, so no one is immune. The transmission effects, could depend on several, dimensions, including the region, the sector, the rating level. But what is happening for sure will accelerate, the structural shift that is happening, across European corporates. And just to end with the financial institution group, as Ángela said, so the direct exposure is pretty limited. But second round effect, could be more relevant, and of course this might depend, on the, as we said, on the length and the extent of the conflict. I will hand over to you, Keith.
Okay, good. Thanks for that. So do type in your questions now, and we'll just run into. I've got a few questions, which I'm going to, I guess, jump around a bit from corporates to FI to sovereigns. So hope you'll bear with me. Actually, Ángela, can I come to you, because you've kind of touched on it. It's interesting. This week we've got lots of central bank meetings. I think the Fed, ECB, Bank of England, and Bank of Japan all meeting this week. So we'll see. But can you perhaps give some more detail on the potential impact of a change in the interest rate environment when it comes to the profitability dynamics for European banks?
Yes, sure. Thank you. A potential change in interest rate environment could be impactful in terms of profitability dynamics. We've just lived through the adjustment to a downward tendency of policy rates, to which most European banking systems had to adjust relatively quickly. We've had very steep changes, and a change towards increasing interest rate would change profitability dynamics. On the one hand, the majority of the European banking systems are asset sensitive, the majority of banks, with a few exceptions, and that would mean that potentially we would see repricing of the asset side to higher interest rates being beneficial. But an awful lot of the actual impact will depend as well on the extent to which banks are able to control funding costs in that scenario, i.e. control deposit betas from transferring higher rates to their retail cost of funding and corporate cost of funding, but also in terms of the impact on wholesale funding costs. So that those two elements will be we would be potentially witnessing a similar scenario to the previous interest rate hike cycle we saw in the past. And the other very important impact would be to what extent rising interest rates and the elasticity there, it very much depends to what level we reach or we would reach in case there's a hike, is the impact on asset quality, to what extent that actually puts pressure on asset quality and therefore translates on higher cost of risk for banks. I have to say this all also should be viewed in the context of whether we have measures from sovereigns to support the economy, because all of that would also create a different perspective for volumes growth, asset quality, that would otherwise be very much impacted by rising interest rates if they were to materialize.
Yeah. Okay, good. Yeah, thanks. It all makes sense. Carlo, what happens? You talked about this. We talked about this stress test was focused on price of 100, 130. What on earth happens if oil prices go to 200?
Yes, clearly this is a more severe scenario, and I would say this is closer to what was the severe scenario that was highlighted by the ECB when Russia invaded Ukraine in terms of magnitude. Of course, we have to consider that we are not in the 2022, so it's a bit different, the current environment. So countries now are also a little bit more, energy efficient than what they were, before, the invasion of Ukraine, and it would depend also, as Ángela said, on what governments, will do, the central bank, monetary policy, response. So I think all these aspects are important, to assess. But I would say, although it's difficult, to predict at this stage, that probably we are closer to what the ECB was highlighting, in the severe scenario when Russia invaded Ukraine.
Yeah. Indeed, and Karl, let me come to you. You touched on this, but can you perhaps expand on I guess it can be likely, but the disproportionate impact for non-investment grade corporates?
Yeah. So I think there's a couple of things going on here. One, it's probably two main things. One, on average, we've commented on this quite a bit, but we see non-investment grade ratings in Europe and just credits in general are already more under pressure, in part because of the structural shifts that are already in place, right? So whether it's trade discrepancies or structurally higher costs in Europe, just changes in trade flows that are already affecting competitiveness. And then also, we're coming out of a decade of very, very abundant liquidity. So this notion of high valuations helping refinancing, et cetera, has become very much normalized. And there's some debate in the market today around whether that is set to continue, whether we're late cycle and things are going to occur. So that's one aspect. And the other thing, when we think in terms of transmission mechanisms, so you already have that baseline of we're seeing a growing bifurcation between investment grade and non-investment grade. But non-investment grade issuers typically, almost by definition, reflect more concentration of credit risk, whether it's in their business profile exposures. They tend to be less diversified, a little bit smaller, have smaller market shares, less pricing power, et cetera, in their cash flow sensitivity. So if you carry more leverage and your cash flow is a bit more volatile, any marginal step change in cash flow will affect you a lot more than a more diversified, better capitalized entity. And to the point I was just saying, liquidity access. So depending on the business composition, the competitive position, the financial position of the company, the risk is this shock could transmit to one or all of these vulnerabilities simultaneously, and with limited offsetting factors and dynamics compared to what you would see in investor grade. So both, structurally slightly more vulnerable starting point that's been where the pressure has been increasing, and then a much more pronounced marginal effect of the shock.
Yeah. Okay, good. Thank you. Ángela, I think you're very popular at the moment. A lot of questions coming in on the FI side. So, but let me ask you, we touched on interest rate. Well, you touched on interest rates. I guess the other elephant in the room is economic conditions, and I guess the outlook for growth. Could there be other impacts from reaction to the banking sectors in European countries if we do see worsening in economic conditions?
Yes, so I think one of the key factors to watch would be to what extent banks, if a more negative economic environment does materialize and we see economic growth prospects deteriorating materially, whether banks will actually tighten financial funding conditions, lending conditions, and it would create a knock-on effect on the corporate sector and other private sector segments. So that is a clear element that we are monitoring closely, because it could compound in turn some of the profitability and asset quality challenges that I mentioned before that could arise in a more negative scenario.
Yeah. Okay, Ángela, I'm going to stay with you because there's a question which is kind of on the same topic, which is besides asset quality and funding. Okay, it says which banks or banking sectors are most exposed to a drop in their earnings in the region. Now, let's avoid single name comments. That's not necessarily appropriate in this sort of forum. But do you want to make perhaps more generalized comments, maybe about some sectors?
Yeah, sure. So I think the impacts we saw in the last interest rate hike cycle that I mentioned before are a good guide as to where we could see more pressures on profitability. It also depends on the speed and the slope of the interest rate curve and the speed of increases if they were to materialize. Of course, the last hike cycle was pretty quick and the curve was very steep. But effectively, in general, systems or banks that have more fixed non-asset sensitive balance sheets and more fixed asset bases are more exposed because they could feel the pressure on the funding costs, and their ability to reprice the asset side would be more difficult. It would be challenged. It also would depend on the impact on asset quality. So sectors that are particularly exposed to corporate segments that are particularly vulnerable to interest rate rises, as I mentioned before, real estate could again see more asset quality pressures as we saw in the last cycle. So an example of this is very bank specific, so balance sheet structures are very different from bank to bank. But generally speaking, the French banking sector in the last cycle was very evidently facing different challenges than some Southern European banking systems, which benefited from interest rate rises in revenue generation. And then the other side of the coin is, of course, to what extent business volumes are affected. And so there's some systems where business growth and particularly lending growth has been very, very fragile. So to the extent that interest rate rises puts pressure on that, could also it could also have a negative effect on profitability outlook.
Yeah, no, yeah, absolutely. Look, we've got a question about infrastructure in the region, and I'm conscious this kind of falls towards the edges of each of your franchises. But now if we can't answer, we'll get our project finance team to send a response by email. But there's a question about to what extent will infrastructure and project financings in the region be impacted by the current crisis? Some financial institutions might be impacted to a different extent. Does anyone want to dare respond to that one, or we can swerve it and have the project finance guys come back?
I can give it a stab from a corporate standpoint, very, very briefly. I mean, the quick answer is it kind of depends on what kind of project as well. But more generally, from a corporate perspective, and I think in an investor loss perspective, the attractiveness of project finance is you have layers of bells and whistles, and typically creditor protections and cash protections that, while you're operationally tied to the strategy of a large corporate, generally insulate you to a pretty significant degree from the life cycle of that corporate. So my expectation as a corporate professional would be that you would see some effect, but again, it would probably take a different shape. And my guess is the biggest issue is whether or not this is the extent to which this changes your assumptions in terms of construction costs, for one thing, which I think could be a real reality, and then project delays and things like that, as opposed to an immediate knock-on effect. But that's my instinctive response.
Yeah, okay. Thanks for that. Karl, I'll come back to the question about German. I'll come back to you in a second. But Carlo, there's a question. Look, you've made, I guess, a fascinating comment in your introductory presentation, which kind of is a sort of a seminar in its own right. But let me ask perhaps the question, see if you can respond in kind of top line terms. You said that conflict is testing EU cohesion, and that speaks volumes. That says an awful lot. But look, to the extent you can kind of summarize and generalize, what are the national and political implications?
Yes, no, of course, there could be also implication for national governments, because especially if we see disruptions and a severe impact, current governments can pay the price, especially those governments that maybe have less fiscal space to implement those measures to protect the economy. I think we have to consider these also in light with the fact that we are having several elections next year, in particular, beyond the midterm elections in the US. We will have also elections in 2027. We will have elections in France, in Spain, probably in Italy, and we might we can't rule out that if we see disruptions, populistic parties, potentially can gain additional, influence, and I think it's important, to monitor again the government capacity, to implement these measures and to protect their economies. We can end up with even more fragmented, parliaments, so that could be very difficult in terms of implementing, reforms.
Yeah, absolutely. Okay, that's a good short response. I mentioned, Karl, there's a question here. Let me come back to it. I asked about non-investment grade, and there's a comment here, asking you to comment on default risks on the German corporate sector, especially non-investment grade or lower investment grade sector. And the questioner says, as you know, Germany has been suffering from weaker economic growth in combination with many structural issues. Do you want to have a stab at focusing just on Germany?
Sure, and that's a separate, broader conversation, and I don't have all the data at hand, but I think maybe tying it back to some of the comments today, when you look at Europe today, in a sense, you have the big four economies. You have Germany, France, Spain, and Italy. They're a little bit one cohort, and then you have Southern and Eastern Europe, and the dynamics are a little bit different. For Germany in particular, and I think this is probably the same thing we see for France in broad corporate terms, is in relative terms within Europe. I mean, this is where we expect the growth to come from, right? It remains a very healthy economy, etc. What tends to happen, and I'd have to come back with the more detailed data, but when you look at when you step away from where bond spreads are and you step away from where market valuations are right now, but you look at the data on the ground, we have seen default rates creeping up. Generally, we have seen, I think, Ángela, correct me if I'm wrong, but I think non-performing loans generally in Europe creeping up as well. So there are definite indicators for fragility, and you already have these trends, these big structural shifts, like, again, higher energy prices in Europe on a global basis that have affected competitiveness, whether it's in manufacturing, whether it's in certain specialty sectors, changing trade flows, which have created much more significant import competition. You have, we all talk about AI disruption all the time, all these kinds of trends occurring at the same time, plus a need for very significant spend for security, whether it's energy security, defense, etc., which invariably trickles down to the corporate sector. So we're already in a situation where even in the large economies such as Germany, there is pressure, there is structural pressure. I think the idea is that this will add to the pressure. Having said that, and again, as a separate conversation, certainly within the EU, Germany remains one of the best positioned economies and corporate kind of maps to be in a position to absorb some of these trends. So, but happy to take it offline for a more detailed view and more specific, drill down.
Yeah, sounds good. No, we can definitely do that. I'm conscious of our time here, so I do want to bring it to a close in a few minutes. But look, there's still some questions coming in, so I think it's only fair to our viewers that we at least address the questions. And so, look, there's another question about oil prices, and this is perhaps a bit difficult to answer. We may need to go back to our questioner, but the question is this: at what oil price threshold do you observe non-linear tipping points in default risk, where sectors transition rapidly from moderate to dramatic risk, and which sectors are close to that boundary today? Now, I suspect that's tough to answer, but anyone want to do that, or we can go back to the questioner with some ones we've actually thought about that a bit more, perhaps run our model. Would that be a fair conclusion to that question?
I think we can run that analysis and come back, but I don't think we have it right here in the context of this forum.
Okay, I'm going to continue then. How do you compare the risk/impact from the Middle East situation versus all the other various macro challenges that existed before US decided to launch Epic Fury? I'm not sure. Again, that's a tough one to answer, but Carlo.
Yeah. Let me try to take this one.
Yeah.
Yes. No. Of course, existing challenges, are important, and we have to consider that there were already, some important considerations, and problems that areas have to face. If we focus on Europe, we have very low, I would say relatively low economic growth, aging costs that are rising, political fragmentation. So these are important elements that we assess in our analysis. I would try also to consider there are also mitigating factors, not only challenges, especially because we were focused our attention especially on Southern European countries, Greece, Cyprus. So these countries Greece and Cyprus, for example, have very strong fundamentals, in terms of economic growth. They have seen, their debt to GDP ratio declining significantly. So I think we have to compound, and not try to look too much on just on the negative and on the challenges. So I would say that there are also some mitigating factors that we have to consider. Regarding the US, I think we clearly highlighted that the deficit is already very high, and is facing, the potential impact of tariffs could generate additional inflation. And then on top of that, we have, the impact from the Middle East. So this could, again, as I said, also have implication in terms of, the economic outlook, but also on the fiscal. So I think we have to take, a balanced view. So consider not only the challenges, but also, some mitigating factors that I think in Europe, in particular for Southern European economies, are important, to consider, in my view.
Yeah. Okay. Absolutely.
I can add to that as well, Keith, if you'll allow me. And I think focusing on perhaps a little bit of non-investment grade, which is obviously where defaults happen, the structural challenges that we've had they're already in place, right? They're there, and I think you do have a little bit of a bifurcation again between specific market signals such as bond spreads and market valuations, and some of the more on the ground economic indicators that exist. The issue you have is, so all this is already in place. It's a narrative that's happening. We're seeing headlines as well of investor nervousness around the fact that at this point, most of the leverage market is private, which in and of itself is not fundamentally problematic. And it's been, boon for liquidity, but it also means that the traditional risk signals from public markets are less complete today. So you're in an environment, I think some of the nervousness we're seeing is when investors do not have these traditional public market signals, they tend to look at other things. And whatever piece of data you can have, it's easy to start applying it to an entire asset class as a narrative. So you're in an environment where narratives can spread. They spread faster than technical data. And this is just one more piece that gets added onto the narrative. So I want to go back to Ángela's comment about the risk of, say, a disorderly correction. This is what makes me nervous at the moment. And I think we have one more excuse now to start thinking along those terms. And again, there's technical reality, but then I think we should not underestimate the degree to which there's still a lot of reliance today on investor confidence that was built over a decade of very abundant liquidity, and how fragile that is right now. That's part of the test, and that absolutely ultimately trickles into default rates and things like that.
Yeah. Okay, I think on that basis, I think we should close the session. We're almost at our hour, and we don't want to test the patience of our viewers for much longer. So let me thank you, Karl, Ángela, and Carlo, for your incredible comments. Look, I mean, we're all conscious that today's comments were a snapshot in time, and depending on what happens, things could change very, very quickly. So appreciate the efforts to really summarize what's going on. Thank you so much to our viewers for staying till the bitter end. We appreciate your questions. We do need to go back to some of you with some more specific answers, and rest assured we will do exactly that. And so look out for our responses in due course. If you wanted to download the slide presentation today, I think we can make it downloadable, if I'm not mistaken. And so, yes, indeed, there we go. There's a download button there. So please feel free to download the slides. Any questions you have on any aspects of what we've discussed today, or anything that's in the slide presentation, or anything that's on your mind in general, we'll be absolutely delighted to receive questions and observations and comments. Market outreach is a very important aspect of our work at Scope, so we welcome that. And so, look, we talked a little bit about how long this might last, how it escalates, and what the policy response is. Depending on any of those and all of those three things, we may indeed well come back in the short term to give you an update. But I think we'll call it a day there. So thanks everyone again, and we'll see you next time.